Secure and wild bonds. Bonds wild? Sounds really kind of odd. Bonds we think is stable things. You purchase them, you're buying debt for 10 years, 15, 20, 30 even. And you can buy government bonds and make good money, not fabulous money. The wild stuff you think is always the other stuff like stocks, futures. Let's take a look. Really, why do people buy corporate and government bonds? A lot of it is to generate income. They really offer a higher interest rate than fixed income investments like savings accounts or CDs. They're not as crazy as stock. You don't have to watch them as closely, really, as stock. But and then the other part is it can really help diversify your portfolio. You can have that wild 10% over here. You got 90%, toss 50% of it in bonds, and then 40% in stocks, and you have a pretty good portfolio overall. It looks nice, it looks stable. The bonds, they gradually earn money as you go through. You get interest on a regular basis. Sometimes you get dividends from your stock. You can buy a couple wild shares of stock and do fun things. But anyhow, bonds help you diversify your portfolio. And really, big picture, we always assume that you reduce the overall risk. What is a bond? It's a loan. It's a loan you actually buy from somebody. So you're going to buy a bond and you're loaning your money to a corporation or maybe the government. But let's talk about the corporation first. You loan the money, and in return, the company agrees to pay you. I will give you 12% if I have this for 20 years, and you'll get a check every single year for your $10,000 bond over here. I'm going to give you some serious cash money every single year. Yes, you too. Wait a minute. Isn't 12% kind of high? Why is that? Oh, wait a minute. It may not be a bond that's rated really high. We'll talk about ratings in a little bit, but maybe it's not that triple A, triple B. Maybe it's a C, which isn't good. You see? Know what I mean? Anyway, so that being said, you might not see your money by the time you're all done. Be careful. So corporate bonds, they have shorter maturities than government bonds, usually 10 years less. You will find some bonds out there for 15 and 20 years. Usually, if you're going out that far, you tend to focus in on government bonds. You're really trying to get corporate bonds about 10 years, but they tend to have higher interest rate than government bonds. Let's face it. Okay, if you buy a bond from Willie and Herman's Air Conditioning, it doesn't sound really good. If you buy a bond from General Motors, there's a good chance it's going to be around 100 years. Willie's and Herman's may not be there next year or 3 months from now. You really don't know. The federal government, listen, if the federal government goes belly up, we're all in big trouble, and maybe money won't even matter. So that being said, so between all of them, you're looking at the risk factor is a big deal. So that's why corporate bonds will always tend to have a higher risk level than the government bonds, but also it's going to depend. If you're buying bonds in a startup that only has 3 years of life existence versus buying bonds in a GM that's been around over 100 years, you're really looking on 3 years, 100 years. This has been around 100 years, 3 years. We'll see what happens. Technology is going to jump. That may not be. Okay, so the risk is higher, so you should get a higher interest rate on it. So a lot of that really is that risk factor that we talked about time and again. A government bond, it's a loan you make to the government. In return, they pay you a fixed interest rate from a set period of time, and they repay the principal at maturity, just like you would at the corporate bond. But that being said, they have longer runs. Sometimes you get these weird bonds for 30 years, and right now, the interest rate is really out of there, and by the time inflation is going nuts, and you're getting the bond for 30 years and it's paying 4% interest and inflation 7%. Sometimes you get these strange anomalies, and they actually make sense sometimes. So it depends where it's at. You really have a lower credit rate because there's less risk. The higher the risk, the more you earn. The lower the risk, the less you earn. Government bonds typically always pay lower than corporate bonds because there really is just about no risk. The problem is if government goes belly up, you just pay, basically money's no good, your house is no good, the streets and law and order is no good. So that being said, we may be there, but not today. So that being said, a government bond is worth something, but it's lower risk, so therefore you make less money. Bonds always have a maturity date as to what is there. On the maturity date, the person that owns the bond is supposed to pay you the face value that's on the bond. Doesn't matter what you paid for it. If you get a $10,000 bond and maturity date, they're to give you $10,000. The interest rate is also on the face of the bond. Now, by the way, a lot of times you don't get a piece of paper on the bond. Usually it's digital nowadays. But that being said, maturity date, interest rates there. And a lot of times you'll have a call provision. Even government bonds sometimes have call provisions on them. In other words, if something happens, let's say that somebody's out there, they sold bonds and they're paying that 12% interest rate, and interest drops, and they want to sit down and stop paying that high interest. And they have enough cash money because they've been successful this year. So that being said, they say, come on back, come on back. They're calling the bond back, and they may pay off the face value of that bond early if they have that call provision. Sometimes the call provision will have extra money to call them back, and sometimes not. Just depends what's on the face of the bond. But they'll have the right to repurchase that bond from the investor before the maturity date. It's a lot more common in corporate bonds. So there's a lot of different kinds. You have investment grade bonds that are issued by companies with strong credit rating. Yes, they're considered the safest type of corporate bond. Sometimes they call them blue chips. So you'll see like the blue chips typically would be the Dow Jones Industrial Average. Those things, they're really fancy stuff. You're all over there, you buy investment grade. Sometimes you get the high yield with companies that have lower credit ratings, and they're considered to be riskier than investment grade bonds, but they still offer higher interest rates because they're a little bit riskier. And then convertible bonds, they only sell those for companies that make convertible cars. No, they don't do that. A convertible bond can convert the bond into shares of stock at a specified price. They offer a potential for both income, because it's a bond, and capital appreciation. And sometimes there's a ratio. You buy a convertible bond, it could be you can convert this bond, this $10,000 bond, into 20 shares of stock. Well, that means that right now, if you're looking at that for a $10,000 bond, by the time you're all done, you shrink it, you'll have a cash value for that. But maybe that cash value isn't much, or maybe it's outrageously high later on, but the stock may go up. And even though the stock may be here at $500 now, and the bond, though, you convert it, and you only had to pay $200 for that $500 share of stock. So sometimes those convertible bonds over time, they can become highly valuable if you decide to convert them in the process. Bonds still have a credit risk. Okay, and the credit risk is always higher than the government bonds because there's a chance the company could default on its debt. There really isn't one for the government. Okay, so by the time it's all done, you'll see the higher credit is there. You also have the interest rate risk. Both corporate and government bonds, they'll have that listed there, and it means if they rise, then the value of the bonds will fall. That could be a problem. So if interest rates go up, then the whole world around you sits there, and the value of the bonds that you paid for, let's say you bought a bond at 3%, and right now inflation is at 7%, the bond is less valuable because it's not accumulating very much compared to what the current market is. So you have that risk there. Liquidity. Between the two, they can both be easily sold, but the liquidity of corporate bonds can depend upon the credit quality of the issuer. They might have been a B once upon a time when they first issued it, but maybe they've sunk down to a C. So all of a sudden the bond is worth less money. So if you need to liquidate it, the chance of a corporate bond not being the same value compared to government bond is really different and a much higher probability. The yield, it depends what you have until the bond matures. If you have 7 years left on a 10-year bond in the corporate world, and it only has a 5% interest rate on it, that's not bad. But if the current interest rate out there, you can get other bonds for 9%, all of a sudden now the whole cost of that bond and the value you can sell it for is lower. So sometimes that's a variable. Here's kind of your basic thing of the ratings. All three of them, they have triple A's, double A's, A's, double B's. And when you start hitting the single B level, all of a sudden you have that rating we call it a junk bond. In other words, it's really bad because of the fact that by the time it's all done, this is nothing but trash. And it's a cheaper bond, but the interest rate, we can make it, it's really good. Really, if you get a junk bond, you better make certain that's that 10% wild money you have in your portfolio. You really don't want to have that. If you go down to the C level and the D level, you really are risking a lot of things. Now, sometimes that you can get it dirt cheap, and there's a reason for that is because there's a chance the company goes belly up. But if they survive, there's a good chance that maybe you'll make massive amounts of money. So the bond ratings here, really, you want to get AAA bonds whenever you can, or AA. You can get triple B, that's not bad. As soon as you hit that single B level on all these three different categories, then you start getting speculative, or what we call the junk level bonds, and those are risky speculative bonds. So how do you buy them? You buy them through a broker. Compare the fees and commissions, make sure the broker's licensed and regulated, make sure they're trustworthy, wink, wink, wink. Are any brokers trustworthy? Anyway, so open a brokerage account, deposit funds, start shopping for corporate bonds. Yo, I want to try that one in a medium. Yes, that's how you do it. So anyway, when choosing bonds to buy, be sure to consider the factors such as credit rating. You want to look at that. You really make sure it's a safer return, but your goal on it is to have a fixed return on a regular basis. It's guaranteed to pay you whatever the face value is for that aspect of the interest rate that's on the face of the bond. It's a good hedge against inflation, but sometimes inflation just gobbles up the interest over it and you're still behind. Your bond might pay 3% interest, inflation's at 7%. No matter what you do, you always get a little bit wider range because the problem is that the world is moving at 7%, your bond is only going to 3%. So watch that over there. 2 ways to get it. Corporate bond, you can also go to an exchange traded fund, an ETF. Those are baskets of securities. We talked about them previously. ETFs are really good because you have a whole variety of them. So you buy some aspects of the ETF and all of a sudden, boom, you have it. A lot of mutual funds have bonds in them as well. So you can also go the easy route and get a basket of stuff with a mutual fund or an ETF in the process. You can always buy a bond and then cash them in. You just cash them in by redeeming them for the principal value with the accrued interest. And you can even cash them in before the maturity date if you choose to do that. So tips on investing in corporate bonds: research. Make sure you diversify your portfolio. And a lot of times you want to rebalance your portfolio depending upon what the current market is out there. So in conclusion, corporate and government bonds, they're debt securities. They give you a fixed stream of income that helps strengthen your portfolio. It makes your portfolio more dependable. And a government bond is always safer than a corporate bond, but both tend to have lower interest rates. Corporate bonds will be higher than government, but they carry more risk. By the time it's all done, they have the maturity date, the interest rate, and usually a call provision on there. But regardless, this is something good to have in your portfolio. It'll add some stability if you want to have some volatility on the other one, the stocks. So bonds, wild and secure, just depends what you want, and make certain that you don't go too wild in the process so your portfolio is still there next time you take a look at it when you pop open your phone. Take care.